Picture this.
You walk into a casino and it's all bright lights, the sound of jingling coins, and the little voice in your head saying, "Come on, let's gamble." And now you're thinking that whether this channel is the better investor or the better gambler. But here's the twist: investing is a lot like betting in a casino. When you decide to buy a stock, you're not just investing money, you're placing a bet on its future success. Just like a poker player weighing their odds before pushing their chips in, you need to assess the risk involved. Many of the legendary investors of the likes of Warren Buffett, Charlie Munger, Peter Lynch, and Bill Ackman have themselves related investing to a lot like playing bridge, blackjack, or poker. So, who better to learn it from than a professional poker player, Annie Duke? She's former cognitive psychology researcher turned high stakes poker champion, with wins totaling over $4 million when this book was written in 2018. Duke has mastered the mental game of poker and applied it to decision making. Her approach has fascinated top investors, business leaders, and even hedge fund managers looking to improve their judgment in high stakes environment. This is the Better Investor, helping you achieve your financial goals and freedom by summarizing top financial and investing classics for you. And these are top 5 lessons from the book Thinking in Bets, written by Annie Duke. Lesson number 1: The flaw of resulting. Take a moment to think about the best decision you made in the past year. And now, think about the worst. Chances are you're linking your best decision to a positive outcome and your worst decision to a negative one. But here's the catch: good decisions and good outcomes don't always go hand in hand. We naturally tend to judge decisions by their outcomes, but this can be misleading. Imagine driving home safely after having 4 bottles of beer at the bar. The outcome here, that is getting home in one piece, was good, but the decision to drive was undeniably poor. Or consider a game of Russian roulette with 5 bullets and 1 empty chamber. Say you pull the trigger and survive. Despite the life-saving outcome, anyone can say that the decision was reckless and incredibly risky. Now imagine repeating the Russian roulette decision again and again. It's only a matter of time before it results in tragedy. Judging decisions based on single outcomes can lead us to dangerous conclusions. In investing, we see this flaw in action all the time. Maybe you did extensive research before buying a stock, only for it to drop by 20% over the year. Meanwhile, another stock you bought impulsively on the advice of a stranger has skyrocketed 400%. It would be easy to assume that your unresearched decision was better simply because it paid off, but relying on outcomes alone rather than evaluating the decision process is a trap. This bias, that is, thinking that good outcomes mean good decisions and bad outcomes mean bad decisions, is what Annie Duke called resulting. And if left unchecked, it can distort our thinking and ruin our decision making. Lesson number 2: Bet on your beliefs. Well, in military aviation, there is a very famous poster which you can find in many ATC workstations. It says, if pilot makes the mistake, the pilot dies. And if ATC controller makes the mistake, the pilot dies. In Thinking in Bets, Annie Duke argues that we make better, sharper decisions when something significant is at stake. When we have skin in the game. Think about military aviation. A pilot flying in a mission makes careful decisions with every maneuver knowing that his life is on the line. Meanwhile, the controllers on the ground, sitting in an air-conditioned compartment, are somewhat removed from that immediate risk. Their advice may still be valuable, but without the same level of personal stake, they might not experience the same decision-making intensity as the pilot who faces life or death consequences. Duke suggests that we bring the same sense of commitment into our everyday decisions by asking, "Wanna bet?" This simple question pushes us to treat our beliefs like wagers, encouraging us to weigh the evidence, assess risk, and consider probabilities instead of assuming we're right. By adding this element of personal stake, we are more likely to make balanced, rational decisions. For investors, this questioning mindset is crucial. Imagine you're evaluating a company's stock and the management is painting a rosy picture about the business, projecting big future gains. It would be easy to take this at face value and believe in the growth story, but if you take deeper and notice in the shareholding pattern that management is quietly reducing their stake, then you may want to reassess. This signals that the very people running the company might not be as confident as they appear publicly. By asking yourself, would I bet on this growth story? You force yourself to reevaluate, weighing all available evidence, including the potential that management isn't fully committed. Adopting this thinking in bets approach helps you make more informed decisions. You aren't blindly following the optimism. Instead, you're weighing the probabilities, considering the risks, and looking beyond the surface. Lesson number 3: Self-serving bias. Self-serving bias is when we take credit for our success, claiming them as the result of our brilliance and skills. But when things go wrong, we blame everything but ourselves. Luck, sometimes bad timing, or any other external factor. It's like being the hero in a story when you win the battle, but when you lose, it's the villain that cheated. But why does this happen? This bias happens because we all want to feel good about ourselves, especially when it comes to our decision making. If things go well, we want to believe it's because we are smart, strategic, and talented. But when things go south, it's easier to blame external factors instead of admitting that maybe, just maybe, we made a poor decision. So in the case of those YouTube gurus, when the stock goes up, it's their brilliance they've nailed it. But when the stock crashes, it's the market's fault, or nobody could have predicted that. This makes them look like they're in control, regardless of the outcome. Well, we need to understand why self-serving bias is dangerous, because it stops us from learning. If you only take credit for the wins and ignore the losses, you'll never learn from your mistakes. Investors who ignore the reasons their picks went wrong will keep making the same mistakes and won't improve. Second, it makes us overconfident. When you only see your wins as a result of skill and ignore the role of luck, you can become overconfident. This can lead to taking on bigger risks or getting cocky in future investments. Number 3, it hurts accountability. If you don't acknowledge your role in a failure, you'll never understand what went wrong. The key to improving is taking ownership of both your successes and failures. Lesson number 4: Motivated reasoning. Motivated reasoning is when we accept information that supports what we already believe and we ignore anything that challenges those beliefs. It's like putting on a pair of rose-colored glasses. You see everything rosy, conveniently overlooking the real color. This bias is especially strong in smart people. Why? Because they're really good at crafting stories that support their views even if the facts don't quite line up. It's like trying to defend a bad decision by coming up with a compelling narrative, even if the truth is staring them in their face. Imagine you're an investor holding a stock in a company that's been underperforming for months. Maybe it's a tech stock that was once a hot favorite, but now the numbers aren't looking great. Instead of acknowledging that it might be time to reconsider your position, you start searching for articles, news stories, or analysts who say the company is overvalued and ready to bounce back. You might even hear things like, "This dip is just a temporary setback, buy the dip." And now you're emotionally invested in the stock and you selectively focus on the good news while ignoring the bad. This is motivated reasoning at its finest. The bias prevents you from making a rational decision, like diversifying your portfolio or cutting losses, because you're so committed to your original belief. You've invested not just your money, but also your mental energy and time into this stock. So it's hard to accept the truth. Motivated reasoning can trap you in a cycle of poor decisions. When you only look for evidence that backs up your beliefs, you miss out on opportunities to improve and grow. Lesson number 5: Mental time travel. Annie Duke says that mental time travel is a powerful tool that helps us make better decisions. It's the idea of using the perspectives of our past and future selves to guide our decisions today. The first technique is past perspective, which is all about anticipating future regret. Here's how it works. Imagine you've made a decision today, say you bought a stock, and then fast forward a year. Picture
how you'll feel if that investment turns out badly, say minus 50%. If you think you'll regret not doing more research and diversifying your portfolio, then this is your signal to act differently now. This technique forces you to think long term. If the potential for future regret feels too high, it encourages you to slow down and weigh the consequences of your decision more carefully. Next, we have future perspective, which is all about visualizing how your decisions today will play out in the future. It's like thinking about person you want to become and making choices today that align with that vision. Let's say you're trying to build future wealth for retirement. Instead of focusing on short-term fluctuations in your investments or the latest stock tips, you shift your focus to your long-term financial goals. Future perspective encourages you to think about the person you want to be years from now and make decisions based on that long-term picture. The third technique is scenario planning. It's all about imagining different possible futures, both good and bad. By mentally running through a variety of outcomes, you prepare yourself for what could happen, which helps you make smarter, more informed decisions. Let's say you're considering starting a new business. Instead of just thinking about the best case scenario, you also imagine things going wrong. What if sales are slower than expected? What if there's a recession? What if your competitors beat you in the market? By thinking through these potential outcomes, you're less likely to be blindsided by unexpected events. Scenario planning also helps you account for risks and prepare for the unknowns, making you more resilient in the face of uncertainty. To summarize, good outcomes don't always mean good decisions, so evaluate the process, not just the result. Treat your beliefs like wagers, assess the risks and probabilities before making decisions. Take ownership of both your successes and failures to improve decision making and avoid overconfidence. Don't ignore conflicting information. Challenge your beliefs to make a rational, well-informed choice. Use past and future perspectives to guide your decisions today, anticipating regret and planning for different scenarios. That's it, guys. If you liked the video, please like, share and subscribe, and don't forget to leave the comment. I will see you soon next week with summary of another investing book. Until then, cheers guys.